Welcome to Brain on Books YouTube channel. Today we are undertaking a deep dive into what is arguably, well, one of the most fiercely debated concepts in wealth building, but also maybe one of the most scientifically proven. We're talking about the common sense of index investing.
That's right. And the source material we're really digging into today makes a pretty radical promise, actually. It suggests that successful, life-changing investing, well, it just shouldn't be that complicated.
It sounds almost too simple, doesn't it?
It does, and it's a truth that often gets, let's say, obscured by how the financial industry works. Their incentives aren't always aligned with simplicity. So for anyone listening right now, maybe you're deep into finance, maybe you're just starting out, our goal, our mission today is to give you the evidence, both the math and the sort of historical wisdom that shows why the simplest strategy is often, statistically speaking, the smartest one for building wealth long-term.
Cutting through the noise. I like that.
Exactly. Giving you the core knowledge you need.
And you can't talk about this simplicity without talking about the man himself, the legend, John C. Bogle. We really have to start with his impact because it just sets the stage for everything else.
Absolutely. Bogle wasn't just, another successful fun guy. He was a revolutionary, a disruptor in the truest sense, founder of the Vanguard Group. I mean, think about it. They manage over $5.3 trillion in assets now. That number alone tells you something about his idea catching on.
It's staggering.
But his real legacy, the game changer, was the product he introduced way back in 1975, the index fund.
Right, the index fund. It was his way of stripping out the complexity, the jargon, and maybe most critically, those really crippling fees that used to eat into returns. He basically offered investors pure market returns. Just here's what the market did, without all the layers of cost that mostly just made Wall Street richer.
He made investing accessible, affordable for, the everyday person.
Instead of trying to find that one magic stock.
Yeah, he shifted the whole focus. Stop trying to find the needle in the haystack, he'd say. Just buy the whole haystack. Own the entire economic engine. He swapped out that, frankly, often futile game of stock picking for just patience, collective long-term ownership.
Okay, so the theory makes sense.
Yeah.
But you mentioned proof. And there's that ultimate million-dollar proof involving Warren Buffett, the Oracle of Omaha himself. This story really boils Bogle's whole philosophy down, doesn't it?
Oh, absolutely. The famous wager. Buffett, who, let's remember, is a master active investor himself.
Right. That's the key part.
He believes so strongly in Bogle's low-cost passive approach that he put $1 million on the line back in 2007. The challenge was simple. He bet that a basic, low-cost index fund tracking the S&P 500 would beat a hand-picked portfolio of super sophisticated hedge funds over 10 years.
Hedge funds. The guys charging enormous fees, using complex strategies, supposedly the smartest people in the room.
The best, most expensive minds finance could offer. That was the bet. Simple index fund versus the supposed cutting edge.
It almost sounds like David versus Goliath, but with spreadsheets.
Right. And the result, it wasn't even close. It was a landslide win for common sense. For the index fund, it didn't just edge them out, it crushed the basket of hedge funds. After you accounted for the huge fees those hedge funds charged, the index fund's returns were significantly higher.
So the complexity, the cost, it was actually their downfall.
Exactly. That's the big aha moment for this whole deep dive, really. Complexity and high costs, mathematically, they're almost guaranteed to destroy long-term performance.
So our mission today is to unpack exactly why that simple index approach wins so consistently. And, maybe more importantly for you listening, how avoiding those hidden costs can literally add millions to your wealth over your lifetime.
We're going to arm you with the math, the logic, the common sense behind it all. Let's start with Bogle's core warning, how this winner's game can so easily become a loser's game.
Okay, let's unpack that phrase. Don't let a winner's game become a loser's game. What's the fundamental difference Bogle saw?
Well, at its base, investing in the broad economy globally, nationally, it is a winner's game. Think about it. Historically, economies grow, companies innovate, productivity goes up. So if you're disciplined, if you're patient, if you take the long view, you're almost certainly going to benefit from that underlying growth. The system itself fundamentally works.
Okay, so owning the haystack works. But then how does it become a loser's game?
It flips the second you introduce friction. That's the key. The moment you start speculating, chasing hot tips, trying to guess the market's next move, day trading,
Or paying high fees.
Or, and this is the biggest one Bogle hammered on, paying high fees to fund managers who are often incentivized to do that speculative stuff. That constant activity, that cost, that's the friction. That's the conflict Bogle zeroed in on. It turns a winning proposition into a losing one for the individual investor.
Okay, so to really get why the index fund is the solution, we need to properly understand the problem first. Let's look deeper at how traditional active investing, like mutual funds, actually works.
Right. Active investing, it starts logically enough. Companies need money to grow, so they sell shares, stock. We as investors want to own pieces of successful companies. Now, researching thousands of companies yourself, it's basically impossible for most people.
Practical, yeah. Time-consuming.
So most people turn to mutual funds. A professional fund manager pools money from thousands, maybe millions, of investors, creates this huge pot of capital, and then they use their expertise, their research team, to invest that money across lots of different companies. They try to pick the winners, avoid the losers.
And the big selling point is diversification, right?
Oh, yeah.
Spread the risk. If one company tanks, it doesn't wipe you out. Seems sensible, sophisticated even.
That's definitely how it's marketed.
Yeah.
But here's the reality check Bogle delivered, and it's pretty stark. The vast, overwhelming majority of these actively managed mutual funds fail. They fail to beat their own benchmark index, like the S&P 500, over the long haul.
Wait, so you pay extra for a professional to beat the average?
And they usually end up underperforming the average. That's the irony. You pay more for less, effectively.
Why, though? Is it just bad luck? Are the managers not smart?
Bogle argued it's not necessarily about lack of intelligence. It's about those silent killers we touched on earlier. They're baked into the system.
Okay, let's drill into those. The fees first.
Right. Killer number one, high management fees. These are charged every year, usually as a percentage of your total assets, maybe 1.5%, sometimes 2.5% or even more. And critically, they get charged whether the fund does well or tanks. It's just skimmed right off the top.
Okay, what else?
Killer number two, frequent trading. Active managers feel pressure to, do something to justify those fees. So they buy and sell stocks frequently. This churn generates high commission costs. Every trade costs money. And crucially, it triggers taxes for you, the investor. We'll get into the tax details more later, but it's a huge drag.
So active managers are essentially starting the race already behind. They have to outperform the market, plus make up for all those fees and trading costs just to break even with the index.
Exactly. It's a massive structural disadvantage. They're running uphill, carrying weights. And you know what often happens because of this? A lot of these active funds end up just basically mimicking the index anyway. It's called benchmark hugging or closet indexing.
Really? So they don't take big risks?
Because the risk of massively underperforming is too high. So they mostly buy what's in the index, but they still charge you those high active management fees. You get passive results at an active price tag. It's kind of the worst of both worlds.
Which brings us perfectly to Bogle's revolution, the index fund. It looks similar on the surface, pools money, but that core mission is completely different.
Totally different. The index fund completely gives up on the idea of beating the market. Its only job is to match the market, or a specific part of it like the S&P 500. Match it as precisely as possible, and this is key. Do it at the lowest possible cost.
So take the S&P 500 index fund. It just holds the 500 biggest U.S. companies?
Exactly. And it holds them automatically, based on a simple rule, in proportion to their market value. So if, say, Apple makes up 7% of the total value of the S&P 500, then 7% of the index fund's money is automatically invested in Apple stock. No guesswork, no predictions.
So there's no need for a star manager making bets?
Nope. No high-paid analyst trying to forecast the future. Minimal trading only when a company enters or leaves the index, or when investors add or remove money. That simplicity is what makes it so incredibly cheap and efficient. Same principle applies elsewhere, like the Nifty 50 in India, tracking its top 50 companies. The goal is the same. Capture the market's return, not a manager's supposed skill.
And the data just overwhelmingly backs this up, doesn't it? Over pretty much any long period, say 15 years or more, index funds consistently beat the majority of active funds, especially after costs and taxes.
It's the math winning out over ego, essentially. So if you're listening and you want to grow your wealth without crazy complexity, without taking unnecessary risks trying to find that needle, and crucially, without giving huge chunks of your potential gains to middlemen, well, index investing is the approach that aligns with common sense.
That clarity is powerful, but to really feel the economic pain Bogle was highlighting, we need to understand that structural problem with the industry. And his parable of the Gothrock's family does this
Oh,
brilliance.
it's a fantastic parable.
Oh.
Really paints the picture of how fees and friction just drain wealth away from the actual owners. So the Gothrock's family starts out incredibly wealthy. Why? Because between all the cousins and uncles and aunts, they collectively own every single share of every company in the entire U.S. stock market.
They are the market, basically, a perfect zero-cost total market index fund personified.
Exactly. They're perfectly diversified, they're patient. As the underlying companies innovate, grow profits, become more productive, the whole family's wealth just grows naturally along with the economy. Pure returns, no friction.
Sounds idyllic, but then the helpers arrive.
Then come the experts. The brokers, the advisors, they start whispering in the ears of individual family members. Hey, Cousin Bob, I think you should sell some of your shares in Company A to Cousin Sue and buy some of Company B from Cousin Bill. You could get an edge.
So it shifts from everyone winning together
To a competitive game between family members.
Right.
Trying to outsmart each other. And what's the immediate result?
Commissions.
Commissions. Every time shares change hands between cousins, the brokers take a cut. Suddenly, the family's overall wealth starts to shrink. Not because the businesses are doing worse, but because money is leaking out to pay the transaction costs. The family's wealth is funding the experts.
And did they realize this and stop?
Nope. As returns started dipping, they thought the answer was more sophistication, not less. They doubled down. They hired professional fund managers, gave up control, started paying hefty ongoing management fees on top of the commissions.
Oh, dear. From bad to worse.
And this is where it really accelerates downhill. These new managers, they need to justify their high fees. How do they do that?
By looking busy, lots of trading.
Exactly. Constant activity, buying this, selling that, often just turning the portfolio to look like they're earning their keep. Every trade means more commissions, more taxes triggered by realized gains, higher administrative costs.
So the Gothrops family, who started out owning everything and benefiting from pure economic growth, ended up poorer because all their potential returns were just eaten alive by layers and layers of fees, commissions, taxes, all generated by the very system they hired to supposedly help them.
The message couldn't be clearer. That complexity, that activity driven by the financial industry's incentives, it primarily benefits the intermediaries, not the end investor.
Yeah.
Bogle's whole point was bypass all that noise. Get a low-cost index fund, hold on to it, and let the actual economy do the work for you, friction-free.
That parable really hits home on the cost side. But let's connect that overmanagement idea to what we actually see in the market day to day. Because honestly, watching the news, the market often seems completely irrational. These wild swings, booms, busts. What drives that?
Bogle broke it down really simply. He said stock prices are influenced by two main things, often pulling in opposite directions. First, there's the rational part, the company's actual earnings, real profits. Sales, innovation, efficiency gains. If a company makes more money, its underlying value goes up. That's the fundamental long-term driver.
The engine of wealth creation, like you said. Okay, what's the second factor?
The second factor is the irrational or maybe speculative driver, emotions and expectations. This is all the hype, the fear, the confidence, the panic, the herd mentality. It's about how much investors are willing to pay for those actual earnings today based on what they think or hope the company will do tomorrow.
And there's a way to measure this emotional temperature, right? The PE ratio, price to earnings.
Exactly. The PE ratio is a great snapshot of that emotional component. Let's make it super simple. Say you invest $100 in a stock, and the company earns $5 in profit for your share over the year. The PE ratio is 100 divided by 5, which is 20.
Okay, so investors are paying $20 for every $1 of current earnings. That reflects a certain level of confidence.
Right. But now imagine some hype builds around that company or its sector. Everyone gets excited. Suddenly, investors might be willing to pay $50 for that same $1 of earnings. The PE ratio shoots up to 50.
Even though the actual earnings haven't changed yet.
Correct. That higher PE ratio reflects massive confidence, maybe overconfidence, pure speculation perhaps. The price gets driven way above the current reality. And the opposite happens in a panic. The PE can plummet even if earnings are stable.
So those wild day-to-day swings we see, the market going up and down, that's mostly driven by this emotional, speculative factor. That's the noise.
That's overwhelmingly the noise. And Bogle's advice, ignore it completely. In the short term, emotions create chaos. That's where active traders try to make money, riding those waves. But Bogle's deep insight, grounded in Graham's work too, is that over the long run, decades, the stock price always eventually comes back to reflect the company's true earning power. The fundamentals win out. The numbers win, always. If the business keeps growing its profits, the stock price has to follow eventually. Which is why patience and ignoring the noise are so crucial in Bogle's world. You avoid getting tricked into costly trades like the Gothrock's family.
Focus on the business reality, not the market drama.
Okay.
That makes sense.
Right. So let's pivot from the philosophy and the noise to the cold, hard math. The devastating numbers that prove why friction costs and taxes is the absolute enemy of building wealth.
We started with Bogle's claim. All investors together must get the market return because we are the market. But individually, we almost always get less because of friction.
Exactly. All those active fund fees, advisor charges, marketing costs baked into funds, trading commissions, they all carve out a slice of the market's return before it ever reaches you, the individual investor. If everyone just bought and held a total market index fund, everyone would get the market return, minus a tiny, tiny cost. But the industry is built to insert itself and take a cut, often a very large cut.
Let's really hammer this home with Bogle's most famous example, the 43-year fee catastrophe. We need to go slow here because the numbers are just mind-boggling. We assume a reasonable 8% average annual market return, and we look at a typical working lifetime, investing from age 22 to 65. That's 43 years.
Right. And let's use a $100,000 starting investment just for illustration. The principle holds true whether you start with more, less, or add money over time. Okay, scenario 1, the index fund investor. You put $100,000 in a low-cost index fund. It earns the market's 8% per year, virtually friction-free. Let compounding do its work for 43 years. What do you end up with?
Okay, 8% over 43 years. Got to be substantial.
It grows to nearly $4.6 million.
Wow. Okay, $4.6 million. That's the power of the market. Compounded without friction. Life-changing money.
Definitely.
Yeah.
Now, scenario 2, the actively managed fund investor. Same $100,000, same 43 years, same 8% market return before fees. But this fund charges what seems like a modest annual fee, maybe 2.5%. This covers the manager's salary, marketing, admin, everything. That 2.5% comes directly off your return each year.
So instead of earning 8%, the investor's net return is only 5.5% per year. 2.5% doesn't sound that dramatic. What does that do over 43 years?
This is where the magic of compounding turns into the tyranny of compounding costs. That same $100,000 growing at only 5.5% for 43 years. It grows to just $1.4 million.
Hold on. $4.6 million versus $1.4 million.
Yep.
The difference is over $3 million just vanish because of a 2.5% annual fee.
Vanish into the pockets of the fund company. Over $3 million lost. You ended up with less than a third of what the friction-free investor got. The fee didn't just cost you 2.5% per year. It cost you 3 times your final wealth.
That's absolutely stunning. It really shows how critical minimizing costs is over the long term. Time and costs, as you said.
Bogle hammered this relentlessly. Costs matter. Hugely. And they're the one thing you, the investor, can actually control.
Okay, so that's the fee drag. But you also mentioned taxes as another silent killer made worse by active management.
That's right. Bogle had that great line, the more motion there is, the lower your return will be.
Right.
And taxes are a big part of that motion penalty. See, every time an asset is sold for a profit inside a mutual fund, it potentially creates a capital gain. And who pays the tax on that gain?
The investor holding the fund shares, right?
Exactly. Even if you didn't sell a single share of the fund, the manager's activity inside the fund, buying and selling stocks frequently to chase performance, generates these taxable gains. These gains are then distributed to you, usually at the end of the year, and you owe taxes on them. It's a constant drag, forcing you to pay taxes sooner and reducing the amount you have left to compound.
Whereas index funds, they don't trade much.
Extremely little. Their portfolio turnover is very low. They only really sell a stock if it drops out of the index or buy one if it enters, or if lots of investors are pulling money out, which tends to happen slowly. This lack of churning means index funds generate far fewer taxable events. Your money stays invested, compounding tax deferred for much longer. They're incredibly tax efficient.
Let's put numbers on that tax efficiency too. The source used a 25-year comparison. S&P 500 averaged 12.3%. Active funds average about 10% before taxes.
Right. Now layer on the tax impact. Because of all that trading, The average active fund might lose about 1.5% per year to taxes on those distributed gains. So their effective after-tax return drops from 10% to just 8.5%.
Okay, 8.5% after tax for active. What about the index fund?
The index fund starting at 12.3% might only lose about 0.6% to taxes due to its low turnover, so its effective after-tax return stays much higher, around 11.7%.
Big difference. So let's run that $100,000 again, but over 25 years this time, using these after-tax numbers. Active fund at 8.5% grows to.
Well, that's $617,000.
And the tax-efficient index fund at 11.7% goes to.
Almost $1.49 million.
Wow. So over 25 years, the difference is, what, nearly $870,000? Just from being more tax-efficient and lower cost?
Almost entirely due to minimizing fees and critically minimizing those trading-related taxes. It confirms Bogle's point again. Fees and taxes are the real enemies you need to fight as an investor. The index fund structure automatically does a lot of that fighting for you.
It builds in the discipline that active funds lack. Okay. Given all this math, the fees, the taxes, where do you put your money? And Bogle's famous advice comes back. Don't look for the needle, buy the haystack.
It flows directly from the evidence, doesn't it? Trying to find that one magic stock or that one scarf fund manager of the needle who can consistently beat the market by enough to overcome those huge costs. Bogle said it's basically a loser's game. The odds are terrible. It's far safer, far more rational, and ultimately more profitable for most people to just own the entire market, the haystack, and get the guaranteed return of the overall economy's growth, minus minimal costs.
And he had the data to show just how bad those odds of finding the needle really are. The source looked at 355 new active funds over a 36-year period. The survival rate alone was shocking.
It really was. First off, more than two-thirds of those funds, 223 out of 355, didn't even survive the 36 years.
They just shut down.
Shut down, merged away due to terrible performance, basically disappeared. So right off the bat, investors who picked any of those 223 funds not only likely lost money or underperformed, they also had the hassle of figuring out what to do when their fund closed.
Okay, so only about a third survived. How did the survivors do?
Not great. Of those still standing, 60 of them significantly underperformed the index. Another 48 basically just matched the index, meaning they failed to add any value for the high fees they charge.
Leaving how many actual winners?
Only 24 actually managed to outperform the index over that 36-year period. But even that number needs a closer look, because of something Warren Buffett pointed out. A fat wallet is the enemy of superior returns. When a fund gets really successful and attracts tons of new money, it gets much harder for the manager to keep finding great ideas and to buy and sell stocks without moving the price against them. Size becomes an anchor.
So even those 24 winners might not have stayed winners consistently.
Exactly. Many successful funds see their performance fade as they get bigger. So when you apply a strict filter demanding consistent outperformance over the entire 36 years, how many funds were left out of the original 355?
I'm bracing myself.
Just 3.
3. Out of 355, that's less than 1%.
Less than 1%. And here's the absolute crux of Bogle's argument for you, the investor. When you invest your money today, you have absolutely no way of knowing in advance which fund, if any, will be one of those tiny few outperformers decades from now.
You're betting on incredibly long odds. Like rolling a die, you have a 1 in 6 chance, about 17%. This is less than 1%.
Precisely. Why would you gamble your life savings on odds worse than a single roll of a die when the alternative is readily available? Own the whole market through an index fund, dramatically reduce your risk, and slash your costs.
It really does come down to common sense when you see the numbers laid out like that.
It does. And since we know costs are the biggest controllable factor, that brings us to the importance of the expense ratio. We need to be laser focused on minimizing that.
Define that again for everyone listening. The expense ratio. What is it exactly?
The expense ratio is simply the annual percentage fee that a fund charges to cover all its operating costs. It's not just the manager's salary. It includes administrative costs, record keeping, legal fees, accounting, and often marketing and distribution costs. Those are sometimes called 12B1 fees. It's the total price tag for running the fund, expressed as a percentage of the assets you have invested, and it gets deducted automatically from your returns.
And we've seen active funds often charge 1%, 1.5%, 2% or more annually. That's money just gone year after year.
Whereas index funds, because they're basically automated, run by simple rules, they're incredibly lean. They don't need big research departments or sales teams. So their expense ratios are typically tiny, often 0.1%, sometimes even lower, like 0.05% or less.
Fractions of a percent compared to active funds.
When we saw the impact earlier with the 43-year example, That difference, even if it's just 1% or 1.5% per year, compounds into a massive, massive difference in your final wealth over decades. It validates Bogle's famous saying, in investing, you get what you don't pay for. Every dollar you don't pay in fees is a dollar that stays in your account, working and compounding for you.
That focus on cost wasn't entirely new, though, was it? Bogle built on the wisdom of those who came before, particularly the father of value investing, Benjamin Graham.
Absolutely. It's crucial to see that connection. Graham, who wrote the classic book, The Intelligent Investor, was doing his main work decades before index funds even existed. He didn't have that tool available.
Right, the context is important.
But Graham's fundamental observations about investors and markets line up perfectly with what Bogle later enabled through the index fund. Graham recognized that most ordinary people, well, they just have neither the time, the interest, nor the temperament to study business conditions constantly. It's just not realistic for most folks to be expert analysts.
So because of that, Graham said most people shouldn't even try to beat the market.
Exactly. He argued they shouldn't try to pick individual stocks or time the market swings. Instead, he advocated for what he called the defensive investor.
The defensive investor. What did that look like for Graham?
For Graham, the defensive portfolio was all about safety, stability, and diversification. The goal wasn't to hit home runs, it was to earn a reasonable return while strictly limiting the risk of big losses from speculation. Keep it simple, keep it safe.
And that sounds, well, it sounds exactly like what an index fund achieves automatically.
It's the perfect modern implementation. By buying a broad market index fund, you instantly get diversification across hundreds or thousands of companies. You eliminate the risk of picking the wrong individual stock. And you eliminate the huge psychological temptation to constantly tinker and trade based on market noise.
Graham had that great analogy too, didn't he? Mr. Market.
Yes, Mr. Market, your hypothetical business partner who shows up every day, totally manic depressive. Some days he's wildly optimistic, offering to buy your share of the business for a crazy high price. Other days he's panicked, offering to sell you his share for pennies on the dollar.
And Graham's advice was?
Ignore him. Ignore Mr. Market's daily mood swings. Focus only on the real underlying value of the business. Don't let his emotions dictate your actions.
Which, again, is exactly what index investing helps you do. You buy the market, you hold it, you ignore the daily drama.
Precisely. And Graham also issued that stark warning about Wall Street itself. He pointed out that the financial industry's main goal isn't necessarily to make you rich. Its primary goal is to generate revenue for itself through commissions, fees, underwriting deals.
Which naturally encourages more activity, more trading, more complexity, the very things that destroyed the Gothrock's family's wealth.
Exactly. So when you put it all together, Bogle didn't just invent something out of thin air. He created the practical, low-cost tool that finally allowed everyday investors to actually implement the timeless wisdom of Benjamin Graham. Be disciplined, be patient, control your costs, focus on the long term, and ignore the speculative noise.
Okay, so let's try to wrap this all up. We've covered a lot in this deep dive.
Yes.
We started by looking at the structure, the high costs, the high friction, the taxes involved in traditional actively managed mutual funds.
Compared to the simplicity, the low cost, the tax efficiency of index funds, which just aim to track a benchmark like the S&P 500 or the Nifty 50.
And the data seems overwhelmingly clear. Less than 1% of active funds manage to consistently beat the index over the really long term.
And the attempt to find that 1%, well, it ends up costing investors literally millions in lost potential wealth over their lifetimes, mostly due to those compounding fees and taxes.
The lessons from Bogle, strongly echoing Graham, are pretty straightforward then. Avoid speculation, be almost obsessive about minimizing costs by using ultra-low-cost index funds,
and stay invested defensively. For the long haul, let time and the power of compounding do the heavy lifting for you.
So for you listening, you now have the logic, you've seen the math, you understand the common sense behind it. You're equipped to make really smart, informed decisions with your money.
Don't get caught up in the hype. Don't just hand over your future earnings through unnecessary fees. Keep it simple. Invest regularly. And critically, stay the course. Focus on the real economy, not the Wall Street noise.
And maybe a final thought to leave you with, building on that data about fund failures. We know 2/3 of active funds eventually just disappear. Think about the non-financial cost of trying to pick funds, the time spent researching, the anxiety watching performance, the stress of wondering if you picked one of the duds.
How much is the psychological peace of mind worth? The freedom you get from just buying the haystack, setting it, and largely forgetting it, knowing you're capturing the market's return with minimal cost and fuss. That's a benefit beyond just the dollars and cents.
If you want to listen detailed summary of more finance-related books, then hit that subscribe button now. Thank you for watching.